Welcome to my new tutorial, Financial Management. In this tutorial, we'll try to give an overview about financial management. The learning outcomes of this tutorial is to develop an understanding about financial management, to learn about the three important decisions that come under financial management, and to gain insight about the impact of such decisions on a corporation, bank, or an organization. So what is financial management? Financial management is basically management of finances within any organization, corporation, or a bank. That is how funds have to be distributed, allocated, and managed in an appropriate manner. Financial management includes decisions in three broad areas. That is, the decisions within financial management are categorized into three broad areas: investing decisions, number two, financing decisions, and number three, working capital management decisions. So investing decisions are mainly related to determining the financial feasibility of any proposed project or investment. So for example, when you start a business, you want to know whether your business will be profitable in future or not. So when you are trying to evaluate the prospects of your business, what you are doing, you are making investing decisions, and you are trying to evaluate the profitability of your business in future. Likewise, if you're running a business and you're asked to make decision whether to invest in a certain project or not, so you will try to make an evaluation whether that proposed investment will be financially feasible or not. So if the project is financially feasible, you will accept the project, and if the project is not financially feasible, you will reject the project. So to determine the financial feasibility of any proposed investment or project, a finance manager has to follow and perform three important steps. Step number one is a finance manager has to prepare a forecast related to future earnings from that investment or project. This is called making a financial forecast. Step number two is whatever the financial forecast is prepared, that has to be discounted. That is, the finance manager has to find the present value of the forecasted earnings. And step number three is to compare the present value of future earnings with today's investment cost. So future earnings can be forecasted with respect to cash streams, which are technically called future cash flows. So for example, as I have made a financial forecast that in year 1, the future earnings will be 45K, in year 2, it will be 50K, and in year 3, it will be 70K. Second step is to do the discounting, that is determining the present value of future earnings, because it's a prediction about the future, and whatever earnings are produced, estimated, it doesn't mean that it will have the same value in present value terms. In fact, in finance, due to time value of money concept, it says that the money depreciates with the passage of time. So whatever the future earnings are, it will be much lower on basis of present value terms. So the present value of future earnings will be lower than the future earnings predicted. So that's why we have to conduct discounting, that is finding the present value of future earnings to get a reasonable estimate. The third step is comparison. In this, we have to compare the present value of future earnings with today's investment cost. The rule is, if the present value of future cash flows or future earnings is higher than today's investment cost, it means the project is financially feasible and the decision shall be to accept the project. No matter what other factors are, how much they are favorable or unfavorable, but the leading criteria to make a decision is on the basis of this financial feasibility, that is, present value future earnings being higher than the investment cost. Likewise, if the present value of future earnings is lower than the investment cost, the decision shall be to reject the project as the project is not financially feasible. No matter how favorable the other factors can be, but the leading factor that has to be considered for making investing decision is determining the financial feasibility and determining whether the present value of future cash flows is higher than the investment cost. So let's try to determine the financial feasibility concept and apply in determining whether project A is more suitable and should be accepted or project B is more suitable and shall be accepted. So for example, project A has an investment cost of $1,000 and the future earnings that will be next year, that is year 1, and it will be $1,500. Project B has the same investment cost of $1,000. However, the future earnings will be in year 4, but their future earnings will be $3,000. That is double of the future earnings in case of project A. Now we have to assume that the discount rate, which is also called the interest rate, that is 20%. So in this activity, we'll try to determine the present value related to project A and the present value of future earnings related to project B. So in case of project A, as the future earnings is 1,500 and that will be in year 1, and the discount rate is 20%, which comes out to be 0.2. And as the future earnings will be in year 1, so the whole bracket will have the power 1. And when we apply the formula, we get the value equivalent to 1,250. So you can see that the present value is 1,250, while the predicted earnings was 1,500. So the present value is definitely less than the predicted earnings. In case of project B, the predicted earnings is 3,000 and that will be in year 4. So as from now onwards there are 4 years involved, so the whole bracket will have the power 4, and we'll plug in the numbers into the respective formula. As I mentioned, 20% is the discount rate, which comes out to be 0.2. So 3000 divided by 1.2 to the power 4, and the present value comes out to be $1,447. So instead of 3000, the present value comes out to be $1,447. Now in both cases, the present value is it's not significantly very different. As you can see, 1,447 and 1,250 in case of project A. So both the projects seems to be competitive. But to exactly want to know that which project is more suitable, we'll have to do the comparison. We have to perform the step number 3, that is comparing the present value of future earnings with the investment cost. As both the projects are having the same investment cost, so we can see the net present value in case of project A comes out to be $250. That is present value future earnings minus the investment cost, and investment cost is 1,000. In case of project B, the net present value comes out to be 447. So both the projects, project A and project B, both are financially feasible because in both the projects, the present value of future earnings is higher than the investment cost. And that's the criteria because in this situation, both the projects have positive value of NPV. That is, NPV in both the projects have come out to be in positive. So we can say both the projects are financially feasible. Now, which project is more suitable? Project A or project B? So for that, we'll have to see which project is giving us higher value of net present value. So in this case, project B is giving us higher value of net present value. So our decision shall be to accept the project B. Now imagine if the investment cost in case of project B would have been 1500 or let's say 1400. So in that case, the net present value would have come out to be just $47, while the net present value of project A, which if we assume that the investment cost is 1000, so that would have come to be $250. So in that situation, project A would have been our preference. Likewise, if imagine that instead of 3000 earnings in case of project B, we would have estimated 2000 earnings. Then the present value would have definitely be lower than what we have got now. And in that situation, it is very likely that project A would have been suitable. So it's a interesting dimension for you to evaluate and look at different options to develop more understanding about how we conduct investing decisions and how we determine the financial forecast and how whatever financial forecast we make after discounting, it gives us entirely different picture. And then the third step, when we do the comparison with the investment cost, then the dimension further changes. So it's an interesting area to look on, and this develops our understanding how we have to make the investing decisions. So we have seen how investing decisions are used to determine the financial feasibility of the proposed investment and how we have to make decisions under investing areas. The second important decision area is financing decisions. In financing decisions, we have to decide about the sources of funding, about the sources of finance. So for every business to expand, or just you have to start a business, you need funding. Now the funding can be like if you start a business, you can put your money as an investment that is called capital. And you can also form partnership in which your partners also make certain investment into the business. So that is called equity financing. Another aspect of equity financing is if the business is like an established business and it's a public limited company. So in that situation, that corporation can issue shares and raise money from the general public or investing firms and raise money against the issuance of those shares. So that sort of funding is called equity financing, equity funding. That is, either the owners invest or the money is generated through investors or general public. The other source of funding is debt financing. That is when a business goes to bank or any financial institution and gets credit from the financial institution. So that is called debt financing. So the financing decision is not just about deciding the sources of financing within an organization. It is even more complicated because its financing decision also involves deciding the percentage of debt financing and equity financing within any corporation. That is, out of over total funding, what percentage of funding shall be based on debt financing and what percentage of funding shall be based on equity financing. We believe in finance there has to be an optimal mix of debt financing and equity financing. It is not recommended to have just equity financing or debt financing because if you create an optimal mix, then that optimal mix leads to value creation and makes your business better off. Now, the percentage of debt financing and equity financing, that is merely based on managerial discretion. It is the wisdom of the management to decide that based on organization's internal and external circumstances, how much percentage of funding shall be based on debt financing and how much percentage shall be equity financing. But giving a rough idea about the percentage, it can be uh, from 40% debt financing and 60% equity financing, or it can vary from 40% to 60% in case of both the sources of funding. In some organization, it can be 60% equity financing and 40% debt financing. In some organizations, it can be 50 to 50. In some organization, it can be 60% debt financing and 40% equity financing. But it's purely a managerial discretion that the management has to take into consideration many different factors to decide that optimal mix. But there has to be an optimal mix because that leads to value creation within the corporation. So, financing decisions, as I mentioned, is to determine the sources of funding and to finding that optimal mix of debt financing and equity financing. The third important decision area under financial management is working capital management. Working capital management deals with finding the appropriate level of liquidity within any corporation at all times. Liquidity means availability of funds in the form of cash. Now, if there is shortage of cash or liquidity within a corporation, then the day-to-day operations will be affected, leading to operational failure and operational inefficiencies. So, within working capital management, it has to be ensured that enough liquidity is available at all times to run the operations of the firm smoothly and efficiently. While there should be enough liquidity to run the operations smoothly and efficiently, but at the same time, there shouldn't be excessive funds in the form of cash because funds could have been invested in more profitable ventures. And when you are not investing funds in more profitable ventures, then it means you are incurring opportunity cost. That is why under working capital management, there has to be an appropriate level of liquidity maintained so that the operations are run efficiently and smoothly, and at the same time, funds are not kept in the form of cash to a certain limit. So in this tutorial, we have covered three important decision areas under financial management, and we have got an overview what comes under financial management. The references for today's tutorial is a book named Fundamentals of Corporate Finance by Ross Westerfield Jordan. You can use any edition and the chapter which is the chapter number 1. Thank you for watching. See you next time, and don't forget to subscribe and like the video. Thank you.